The US Fed is trying to reassure them. The Fed is the Federal Reserve, it's the central bank of America. You see, America was facing its biggest inflation spike in 40 years.
The stock market is doomed, and I'm selling everything. This is the type of comment I'm seeing all over social media right now. I get it, everything's taken a sudden dive, from stocks to crypto. I know many of you who watch my channel have just started investing, so for you, this is understandably pretty worrying. Today, I thought it was important to address your concerns, explain what's causing all this mayhem, and finally give you my thoughts on how you can best navigate the storm. I'm prioritizing getting this video out quickly, so don't expect the editing to be as slick as usual. It's more important for you to hear the information so you can use it to your advantage. This is one video you should definitely not skip. So, why is the stock market plummeting? To put this into perspective, the S&P 500 dropped 3%, marking the biggest one-day drop in nearly 2 years. The Dow dropped 2.6%, while the Nasdaq slipped 3.4%. This sounds pretty alarming, and from my research, there are 4 main reasons for this. Let's go through them one by one to see if we're due for another historic market crash similar to the 2008 financial crisis, or just a little bump along the road. Reason 1, of course, is the fear of recession. If the economy goes into a recession, the stock market would most likely plummet. This isn't always the case, as there have been a few exceptions, like in the 2020 recession when the S&P 500 returned 16.3% for that year. However, that isn't the norm. This makes sense because, during a recession, less money is being spent by people like you and me. Companies then start firing staff, leading to more people being unemployed, which causes people to spend even less. This results in companies earning less, and most of the time, stock prices are impacted. This is one vicious cycle, and I hope you can see why this would be a pretty bad situation to be in. So, if we aren't in a recession yet, why is the stock market going down? Well, as the stock market is known as a leading indicator, whenever there is a hint of a recession happening, it reacts to that news pretty negatively. So, you're probably thinking, what was that hint? Well, several data reports showed that the US added only 114,000 jobs in July, below expectations of about 150,000, and unemployment rose to 4.3%. This is higher than any month since October 2021. Look, these numbers are far from a disaster. The unemployment rate is still relatively low, and the underperformance in hiring isn't terrible. However, it has triggered something known as the SAM rule. This is a pretty cool little rule that activates when the average unemployment rate over 3 months goes up by at least 0.5% compared to its lowest point over the past year. The reason people take this seriously is that it has accurately predicted every US recession since World War II. In response, Goldman Sachs raised its odds of a recession occurring in the next year from 15% to 25%. Interestingly, the woman who came up with the rule, Claudia Sam, doesn't think the rule is going to be right this time. And to put your mind at ease, there have been other rules like this before, such as the bond yield curves, that have turned out to be unreliable recently. One reason why it might be a false alarm is that this time around, unemployment isn't rising because people are losing their dream jobs. Instead, it's because more people are entering the workforce. However, as I mentioned before, unemployment rising is only one factor in the vicious cycle of a recession. The other important one is the amount of money everyday people are spending. Unfortunately, it looks like spending is slowing down too. Now, it may sound odd, but a good way to gauge this is by checking how companies like McDonald's and Walmart are doing, and both have recently said their customers are cutting back on spending. Another company to watch is Wayfair. I actually buy a lot of my furniture from them. I'm sitting on a Wayfair chair right now. They recently mentioned that customers are being very cautious, with spending down nearly 25% from 3 years ago. Now, this all sounds pretty worrying. However, when it comes to the SAM rule, this time around, I'm taking it with a pinch of salt. Even Goldman Sachs seems to agree. Although they've increased their projection on the risk of recession, they still think it's pretty unlikely. There's also a lot of time for the big dogs at the Federal Reserve to swoop in and protect the economy, which leads me nicely to reason two: interest rates. The last few times the Fed cut interest rates from their peak, a recession followed closely behind. And guess what just happened? You got at the US Federal Reserve hinted after its meeting at the end of July that interest rates would soon be cut. Now, this graph also looks pretty concerning. However, it really doesn't show us the full picture. To understand why this time is different from those past examples on the graph, we need to look at why the Federal Reserve initially put interest rates up in 2022. The answer is simple. The pandemic hit, money printers were on full blast, and supply chains were suffering, leading to high inflation levels. The only way to bring prices back under control was to increase interest rates. This was an unprecedented situation, which I don't think we'll see again in our lifetimes, certainly not in mine. When they did this, they set an inflation rate target to hit and said they would start cutting rates once they achieved it. This strategy worked, and inflation has come down pretty significantly from its peak of 9.1% in 2022, but it still remains slightly above the Fed's target rate of 2%. So now, if we go back to the graph, all those past examples of the Fed cutting interest rates were because they were trying to stop a recession from happening. However, this time, it's because they are so close to hitting their inflation rate target. So, the Fed cutting interest rates should actually be seen as a positive move for investors because it helps boost the economy. When rates are lower, borrowing money becomes easier, which means more money flows around. This is the opposite of what happens during a recession. So, on the surface, lots of these factors look worrying. However, when you dig a bit deeper, it doesn't seem as bad as it looks. So, what else has caused the markets to drop so much? That brings me to reason 3: tech stocks. If you recently invested in any of the top tech companies, then you were definitely hit harder than most, especially the stocks in a group known as the Magnificent Seven, which include Apple, Amazon, Alphabet, Meta, Microsoft, Tesla, and Nvidia. Now, you might be thinking, that's fine, I don't invest in individual tech stocks. However, this also impacts the S&P 500 index fund investors, as these top 7 tech stocks actually make up about 31% of the S&P 500, meaning that when tech stocks get hit hard, so does the entire index fund. So, I guess the obvious question is, why are tech stocks suffering? Well, recently, these stocks have been soaring due to the promise of revolutionary AI technology. I went to a conference last year in Texas, and all they seemed to be banging on about were all these different AI tools I should be using in my business. I honestly got a bit sick of hearing about it over and over again. It does seem like the AI craze has caused a bubble to form, pushing some stock prices higher than they should have ever been. Don't get me wrong, I do definitely see the value in AI. It's not like the metaverse. Enough said about that, I think. I just think the value of our current AI capabilities has been widely overvalued, and now investors are realizing this, causing stock prices to fall to more reasonable levels. I'm not alone in this thinking, as Warren Buffett's Berkshire Hathaway slashed its stake in Apple by almost 50% in the second quarter. There also seems to be bad news followed by more bad news coming from the AI space. I mean, just recently, the first preview of Apple's intelligence failed to live up to the hype, and NVIDIA's highly anticipated Blackwell chips will be delayed due to design flaws. These chip delays will also impact companies like Meta and Microsoft, so everything is pretty interconnected. Look, all in all, I personally think investors got a little hyped about AI, and it became a bit of a buzzword. It reminds me of when I was investing during the dot-com bubble in the late 1990s. Just keep in mind that the stocks with the sharpest booms tend to fall the furthest. Reason 4 is the Japanese yen. Now, imagine you discover this really clever loophole. You borrow money from someone with virtually no interest and invest it wisely. Meanwhile, the currency's value drops significantly. By the time you need to repay the loan, the money you owe is worth much less than when you borrowed it, but your investment has grown. So you end up repaying the devalued currency while profiting from your investment's growth. Now that would be a pretty cool life hack, right? Well, it's exactly what lots of traders were doing with the Japanese yen, as it's been falling in value for years. Now, it's a little more complicated than that, but I'm not going to bore you with all the details. It's a cool trick to make some easy money, but why am I telling you this? Well, everything changed when the Bank of Japan decided to raise its main interest rate from nearly zero. So once again, countries are messing with the interest rates. This small change caused the value of the Japanese yen to shoot up rapidly, leaving lots of investors in a pickle. Lots of hedge funds and big banks had borrowed money using yen and had to sell stocks they owned to get the cash to repay their loans. So, while this has nothing to do with the US stock market itself, it's a factor that's played into the sudden drop. Unfortunately, it's another element that could make things worse over the coming months if Japan decides to further change interest rates. So, with all this going on, should you panic and sell your investments? I'd say definitely not. Here's what I recommend instead. First, if you haven't yet done so, make sure you have an emergency fund set up with enough money to cover 3 to 6 months worth of expenses. This is a pretty good rule of thumb to follow regardless of how the market is doing, so you're protected in any financial situation. Second, as I said, I don't believe we're entering a recession right now. Therefore, I'm sticking with my long-term investments and taking advantage of the fact that lots of stocks are now on sale. Third, keep an eye on the news, but don't let it dictate your investment decisions. The stock market is influenced by so many factors, and while some might be concerning, others might be opportunities in disguise. Finally, remember that time in the market beats timing the market. Trying to predict the exact moment to buy or sell is next to impossible, and most who try end up losing money. That's all for today. I hope this video helped ease your worries and gave you a clearer perspective on what's happening in the market. If you found it useful, please give it a thumbs up and share it with others who might benefit from this information.